Every time you put money in a bank, you assume one thing, that the bank is holding your money, that it is sitting there untouched, waiting for you to need it. This assumption feels natural because that is how banks describe the relationship: deposit, store, withdraw. But the moment your money enters the banking system, it stops behaving like personal property and starts behaving like infrastructure. Banks do not want you to actively use your money. They want it to remain statistically predictable, not because they dislike customers, not because they are careless, but because modern banking is a system built around probability, timing, and scale. And still, money is easier to model than moving money. Today, we're exposing why banks prefer deposits that don't move, how your money is transformed inside the system, and why movement is quietly treated as risk. When you deposit money into a bank, there is no digital drawer with your name on it. Your money is pooled with millions of other deposits and immediately reclassified as funding. From that moment, the bank's obligation is not to keep your specific money untouched, but to ensure that withdrawals can be met under expected conditions. This distinction matters. Banks operate on balance sheets, not vaults. On one side of the balance sheet are liabilities, your deposits. On the other side are assets, loans, bonds, and reserves. The system assumes that withdrawals will be distributed over time. This assumption is not a guess. It is derived from decades of data. Banks analyze historical withdrawal patterns, salary cycles, seasonal behavior, and stress scenarios. They model how much cash is typically needed on any given day. They do not need all deposits available at once. They need withdrawals to remain unsynchronized. As long as people act independently, the system holds. Your money just needs to not leave suddenly. From the bank's perspective, deposits are not primarily a customer service. They are a production input. Deposits are among the cheapest and most stable sources of funding. This cheap funding allows banks to earn the spread between what they pay depositors and what they earn on loans and investments. But cost is only part of the story. Deposits also improve regulatory metrics. They support capital ratios. They strengthen liquidity coverage. They signal stability to regulators and investors. A large, stable deposit base allows banks to lend more, invest more, and absorb shocks more easily. This is why an inactive deposit is often more valuable than a larger deposit that moves unpredictably. Unpredictability forces banks to hold additional reserves, which earn little. It may require asset sales at inconvenient times. Stillness reduces friction. This logic explains why banks rarely compete aggressively on deposit interest. Higher interest rates would attract more deposits, but behavior complicates this. Most customers do not optimize continuously. They do not move money for small differences in yield. A change of a few tenths of a percent rarely triggers action. What does trigger action is inconvenience. Switching accounts takes time. Automatic payments must be reconfigured. These frictions are powerful. Banks understand this deeply. They price deposit interest rates not to maximize inflows, but to minimize outflows. Just enough interest to prevent dissatisfaction, not enough to encourage monitoring. There is another problem with paying more interest: attention. Once customers care about yield, they start comparing. Movement creates volatility. Banks want depositors who forget. Movement inside the banking system is costly in ways that are rarely visible. Every withdrawal requires immediate liquidity. Every transfer requires settlement. Every payment requires timing alignment. When too many customers move money at once, banks must respond quickly. They may borrow short-term funds at higher rates or sell assets early. This is why friction exists. Transfers take time. Withdrawals have limits. These are usually explained as security measures. Security is part of the story, but the deeper function is flow regulation. Friction smooths demand. A perfectly frictionless system would be efficient, but fragile. A system with controlled delays is more resilient. The delays are calibrated to slow mass movement without drawing attention. Banks do not value customers equally. They value patterns. A customer with a predictable salary inflow is more valuable than one with a large but irregular balance. Salary accounts allow banks to model future cash flows with high confidence. They signal stability. They anchor liquidity forecasts. This is why banks aggressively pursue payroll relationships. Your paycheck arriving every month is not just income. It is data. Bonuses and fee waivers are not rewards for loyalty. They are incentives for predictability. At the center of all of this is a risk banks constantly manage, but rarely discuss openly: timing risk. The banking system is not designed for everyone to act at once. A bank run is not primarily about whether assets exist. The problem is that many assets cannot be liquidated instantly without loss. When confidence erodes, people act together. Timing compresses. This is why confidence is treated as a critical asset. Communication during stress events is carefully calibrated. Narrative matters because narrative controls behavior. The difference is timing. The system is designed so that when it works, it feels boring. No drama, no urgency. Boring systems attract little scrutiny. If banking felt exciting, people would monitor it closely. Questions lead to movement. So stability is framed as safety. Inertia is framed as trust. The best customer is not the most engaged one. It is the one who behaves exactly as expected. This is not a story about villains. Banks are not malicious actors. They are institutions responding to incentives, regulations, and mathematics. They optimize for predictability. Within that system, your stillness is productive. Your inactivity stabilizes the machine. Banks do not want your money to grow. They want it to behave. Quiet, predictable, statistically boring. In the next episode, we'll expose why free checking isn't actually free. This is not financial advice. This is system literacy. If this made you uncomfortable, that's expected. Systems reveal themselves through incentives. Banking doesn't fail because people behave badly. It works because people behave predictably. Once you understand the system, you stop taking its outcomes personally. We don't give advice. We explain the machine. If you want to keep seeing how everyday systems actually operate, subscribe. Because clarity isn't empowerment. It's orientation. We explain how the machine works. See you next time.